Hey, welcome back. It's Jason Walty here. I want to give you guys an update regarding some early indications of home buying demand, what could be impacting our housing market in the weeks and months ahead. So let's go ahead and dive right in. This is based on an update that was posted by Redfin just before Thanksgiving. And by the way, hope you guys had a great Thanksgiving, by the way. Let's talk about some early indications of home buying demand. It says here mortgage purchase applications. In other words, these are applications for people to buy houses who are getting loans to buy houses. Mortgage purchase applications and Redfin's Home Buyer Demand Index both increased as rates stayed around 6.6%, down sharply from around 7% that we saw earlier this month. And by the way, I'll share an update regarding mortgage rates with you guys here in just a little bit. It says supply is piling up, posting a record annual increase in housing supply, as pending home sales fell the most on record. And also, I should have mentioned this as well. This is going to be a two-part video series I'm making because part one is this video today because I'm going over some early indications of home buying demand. But part two is a video I'll post probably today as well regarding the most recent trends we have regarding home prices, pending home sales, inventory, price reductions, and of course, much, much more. So stay tuned for part two of this video that I'll post very, very soon. So according to Redfin here, for the week ended November 23rd, the average 30-year fixed rate mortgage was down to 6.58%. So average rates right now around 6.58%. But this is according to a weekly survey from Freddie Mac. If you guys follow the channel, you guys all know I'm not a huge fan regarding their weekly updates regarding rates because this is based on a weekly survey for rates. And so given the volatility in our mortgage rate market or the lending market that we have regarding rates, the survey here doesn't really tell us exactly what's happening. However, though, ever since really November 10th, rates have been more or less hovering around 6.6%. So in other words, because rates haven't fluctuated very much over the past couple of weeks, this update from Freddie Mac is actually kind of timely here. It says here in recent weeks, rates have hit above 7%, only to drop by about a half a percentage point. The volatility is making it difficult for potential home buyers to know when to get into the market, and that is reflected in the latest data, which shows existing home sales slowing across all price points. So as of November 23rd, Freddie Mac is stating that the average rate is 6.58%, of course, for people with exceptional credit. And these rates, by the way, are for people putting down at least 20% down payment to buy houses. Also, according to Investopedia.com, as of today, which is November 28th, average rates for people with exceptional credit is 6.95%. This is actually a little bit higher compared to what the Mortgage News Daily is reporting today, because they're reporting rates right now at 6.62%. One thing I found interesting regarding this update here from the Mortgage News Daily is the difference between a 30-year fix versus a 5/1 ARM. In other words, it's fixed for 5 years, then rate becomes adjustable thereafter. So the spread between a 30-year fix and a 5/1 ARM, according to the Mortgage News Daily, is approximately 0.4 percentage points. And therefore, this is causing a lot of home buyers to flock away from getting adjustable rate mortgages and moving toward a 30-year fix, which in my opinion is a good call because a 5/1 ARM, in my opinion, is much more risky compared to a 30-year fix. Something also worth noting regarding this is that the spread between a 30-year fix and a 5/1 ARM about a month or two ago was 1.3 percentage points. And that's why the share of people applying for adjustable rate mortgages were increasing so much earlier this year. But right now, the spread is only about 4 percentage points, so a lot of people are moving to a 30-year fix versus a 5/1 ARM, for example. Also, in looking at rates 1 year ago, rates were averaging at 3.24%. In other words, rates have increased approximately 3.38 percentage points over the last 12 months, or 338 basis points. So one last thing I want to mention regarding this is that even though rates have decreased, because back on October 20th, average rates according to the Mortgage News Daily was 7.37%. Now rates are around 6.6%. But even though rates have been decreasing more or less ever since then, rates are still about twice as much as they are right now compared to a year ago. And going back to Redfin's report here, here's something actually they got wrong. They're absolutely incorrect regarding this statement right here because they say mortgage purchase applications during the week ended November 18th increased by 8.7% from 1 month ago on a seasonally adjusted basis here. That's absolutely wrong, because if you actually go to the actual report here, and in my opinion, ever since they had layoffs by Redfin back in June, their updates have gotten more and more sloppy. I tend to find a mistake probably every a couple of weeks. I email Redfin, they never respond. However, though, they do revise their updates based on the errors I find. But I'm kind of sick of being Redfin's auditor here, because this is actually incorrect, stating that applications for people using loans to buy houses increased by 8.7% from 1 month ago on a seasonally adjusted basis here. Because you actually go to the actual report here. This is a report from the Mortgage Bankers Association for the week ended November 18th, which is exactly the same week that they're referring here, increasing by 8.7%. This is for a non-seasonally adjusted basis, though, because look at this. The unadjusted purchase index increased 9% compared to the previous week. However, though, on a seasonally adjusted rate here, it increased only by 3% from 1 week ago. So this is actually not 8.7%, it's actually 3% on a seasonally adjusted basis. Therefore, this report from the Mortgage Bankers Association states here that the seasonally adjusted purchase index increased only by 3% compared to 1 week ago, and also the unadjusted purchase index increased by 9% compared to last week, and decreased by 41% from the same week 1 year ago. In any case, moving on. Joel Kahn, who is the MBA's Vice President and Deputy Chief Economist, stated the following. The decrease in mortgage rates should improve the purchasing power of prospective homebuyers, who have been largely sidelined as mortgage rates have more than doubled in the past year. As a result of the drop in mortgage rates, both purchase and refinance applications picked up slightly last week. However, though, refinance activity is still more than 80% below last year's pace, because the refi index decreased by 86% last week compared to the same week 1 year ago. And also, as I mentioned, the spread between a 5-1 ARM versus a 30-year fixed has been narrowing to 0.4 percentage points compared to approximately 1 to 1.3 percentage points about a month ago. The share of people using ARMs to buy houses right now has decreased to 8.8% of all loans last week. And that's down from the range of 10 to 12% that we saw over the past couple of months. It's still worth mentioning, though, that back in January, the share of people using ARMs, or adjustable rate mortgage loans, to buy houses was around 3%. So at 8.8%, that's still nearly 3 times the share compared to January of this year. The MBA also noted that approximately 28.4% of all mortgage applications were coming from refis. So more or less 3 of every 10 applications for mortgages are coming from people doing refis. I'm guessing the vast majority of these people are doing cash out refis, because it really doesn't make a lot of sense given the fact that rates were averaging at around 3% back in 2020 and 2021, and rates right now are about 6.6%. So it really doesn't make a whole lot of sense for people doing a regular refi. So I'm guessing the vast majority of these people who are doing refis are doing cash out refis. I should say that's my opinion, though, and it's pure speculation. But what do you guys think? Comment below. Redfin also noted that fewer people are searching for homes for sale on Google, down by 38% from 1 year ago, which obviously makes sense given the slowdown in home buying demand. Obviously, fewer people are searching for homes for sale on Google. Also, Redfin's Home Buyer Demand Index, which is a measure of requests of home tours and other home buying services from Redfin agents, was actually up 1.6% from 1 month ago, but was down a whopping 33% from 1 year ago. And here's a chart showing just that. Their demand index down by 33% on a year-over-year basis, far below 2020 here in gray, and also far below 2021, which is the blue line right here. And their demand index has been more or less decreasing ever since April this year, which coincidentally, that's when average rates were approximately 5%. And coincidentally, this is in line with what Redfin stock has been doing, because look at this. Redfin stock is down a whopping 46% over the past 6 months. It's currently trading at $5.20 a share right now. Also, year to date, look at this. Year to date, Redfin stock is down a whopping 86%. Over the past 1 year, down by 87%, And on top of that, over the past 5 years, Redfin stock is down by 77.47%. Redfin also noted that real estate showings across North America have been declining big time as well, because according to Redfin here, touring activity as of November 20th was down a whopping 35% to start the year. This is according to showingtime.com. If you actually go onto their website though, the stat here down by 35%, it's actually much worse right now. Because look at this. This is for the week ended November 27th. And for the week ending November 27th, showing activity is down a whopping 54.3% compared to January 1st of this year. Compare this to 2021 this time, showing activity was down 37% compared to the start of 2021. And back in 2020, home showings were down by about 20%. One thing I do want to mention regarding this is that it's entirely normal to see fewer real estate showings during the holidays. So this week right here is really impacted by the Thanksgiving holiday here, down by 54% compared to the start of this year. But still at 54%, this is much lower than the 36.9% decrease we saw last year. And on top of that, real estate showings across North America have been in the negative territory ever since really July 14th of this year, meaning fewer real estate showings in North America compared to the first week of this year. And lastly, one more report I want to share with you guys that actually went over in a separate video. I'll leave a link below for this video if you guys want to take a look at it. It's regarding new home sales in the United States. And these are only for brand new single family houses. That actually increased by 7.5% last month. That was an increase from September to October of this year. Increased by 7.5% in the number of new single family houses that actually sold. Again, though, this is based on a new report from the US Census Bureau, which defines a new home sale as when a contract is signed. So this is really acting like a pending home sale, a leading indicator of our housing market. Up by 7.5% on a month-to-month basis, but still down by 5.8% from October 2021. And meanwhile, there's approximately 470,000 brand new single-family houses that are for sale right now in any stage of construction, whether it's a dirt lot, under construction, or completed. So 470,000 is the total number of houses that are technically for sale in the US. And that's up by 21.4% from 1 year ago. But also the current levels right now at 470,000 are the highest levels since March of 2008. So here's Uncle Fred's website right here. Housing supply for brand new houses is 470,000 right now. The highest levels since March of 2008, when we had approximately 470,000 as well. So we're seeing this huge increase of housing supply of brand new houses in the US. And also the month supply of brand new houses right now is sitting at 8.9 months. That's actually down from last month when the month supply was 9.4 months, but up by 29% on a year-over-year basis, because 1 year ago, the month supply of brand new houses was 6.9 months. And with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.